Welcome to the Deep Dive. Today we're tackling something every investor, well, hopes they don't encounter, but really needs to understand. What happens tax-wise when your investments lose money?
Yeah, it's crucial. Investing is exciting, sure, aiming for growth,
Yeah.
but sometimes things don't go to plan.
And those losses, they don't just vanish. How the tax code treats them, it can seriously impact your bottom line. It's not just, dry rules.
Not at all. And these rules, they actually exist for a good reason to stop some, well, pretty significant abuses we saw in the past.
Right.
So today, our mission is to cut through the jargon. We're looking at three main things: the at-risk rules, the passive activity loss or payout limits, and the investment interest limits.
Right.
We want to break these down, make them clear, give you actionable insights so you know what matters most for your own strategy.
Okay, let's do that. But before the what and how, maybe we should start with the why. I mean, why did Congress even need rules like at risk and these payout things? What was going on?
That's the perfect starting point. The why goes back to this big issue, often called the tax shelter boom.
Tax shelters sounds a bit shady.
Well, some of them were, frankly. Investors, or rather the people structuring these deals, got very clever. They created these complex setups to generate huge paper losses.
Paper losses. So not real money disappearing.
Not always in the way you'd think, no. They were often accounting losses, structured to create massive deductions. And these deductions could then shelter, huge amounts of other income salaries, business profits, investment gains.
So using a loss from one area to wipe out taxes on completely different income.
Exactly. And often the investor wasn't even truly risking the amount they were deducting. So these limitations, the at-risk rules, the PL rules, they were absolutely necessary to curb that. To make the system fairer, so deductions reflected actual economic risk, not just fancy paperwork.
Okay, closing loopholes. That makes sense. So the first line of defense against that is this at-risk limit. Sounds simple, how much you actually risk. But what does it really mean for tax purposes? Why is it step one?
It's absolutely foundational. The at-risk rule, it basically does what it says on the tin. It limits your deductions from an investment or a business activity to the actual economic amount you personally stand to lose.
Your skin in the game.
Your skin in the game, exactly. It applies to you as an individual investor and also to certain types of corporations, closely held ones. The problem it really tackled was this idea of multiple write-off.
Multiple write-offs.
Yeah, where investors could deduct losses way bigger than any cash they actually put in. And a key tool for that was non-recourse debt.
Non-recourse debt. I've heard that term. What is that, simply?
Good question. Simply put, it's a loan where you, the borrower, are not personally on the hook.
Meaning?
Meaning, if you default, the lender can take the asset securing the loan, like a building, but they can't come after your personal savings, your house, your other stuff.
Okay.
Under the old system, you could buy, say, a big property, mostly with non-recourse debt, claim depreciation and other deductions based on the full value, even the borrowed part you weren't personally liable for. So you could generate losses far exceeding your actual cash risk.
Wow. Okay. I can see why they'd want to stop that.
Right. The at-risk rules basically said, hold on, you can only deduct losses up to the amount you're actually at risk for.
So how do you figure out that at-risk amount? What counts?
Okay, so your starting point is your direct cash contributions. Pretty straightforward.
Makes sense.
Then the tax basis of any property you contribute. And crucially, any money you borrow for the activity where you are personally liable. You sign the guarantee, you're on the hook.
Okay.
Now, there's one important exception, or rather, addition. It also includes your share of something called qualified non-recourse financing.
Qualified. What makes it qualified?
Generally, this is specific non-recourse debt,
Yeah.
typically from a commercial lender, usually for real estate activities. The IRS recognizes that real estate often involves this type of financing, so they allow it to count towards your at-risk amount, unlike other non-recourse debt.
Got it. And this amount isn't fixed, right? It changes.
Exactly. It's dynamic. It goes up when the activity makes money. Your share of the income increases your at-risk amount. It goes down when you take deductions for losses or when you withdraw money or property.
Okay, maybe an example would help here.
Sure, let's use Ed. He puts $50,000 cash into a partnership. He also personally guarantees $20,000 of the partnership's debt. So his starting at-risk amount is $70,000.
Okay, 50K plus 20K.
Yep. Now, say year one, the partnership earns income, and Ed's share is $25,000. His at-risk amount goes up to $95,000, but he also withdraws $10,000 cash. That brings it back down to $85,000.
Still tracking.
Okay, now same year, the partnership has a loss, and Ed's share is $100,000, but wait, his at-risk amount is only
So
$85,000.
you can only deduct $85,000 of that loss.
Precisely. He deducts $85,000. That uses up his entire at-risk amount, bringing it down to zero. The remaining $15,000 of the loss, it's suspended.
Suspended, so like you said, not gone forever, just paused.
Exactly, it's paused, carried forward indefinitely. If in year 2 the partnership makes money, say Ed's share of income is $40,000, his at-risk amount goes up to $40,000.
Ah, and now he can use that suspended loss.
Right. He now has enough at-risk basis to deduct that previously suspended $15,000 loss. He uses $15K of his $40 at-risk amount, leaving him with $25K at risk going forward.
That's clever. What about that recapture thing you mentioned?
Right, recapture. It's less common but important. Imagine you deducted losses because you were personally liable for a debt. Later, you managed to change that debt to non-recourse. You're off the hook personally.
Yeah.
The IRS says, whoa, the only reason you got that deduction earlier was because you were at risk. Now you're not. So they might require you to recapture those previously allowed losses, basically, add them back to your income in the year your at-risk amount dropped below zero due to that change.
Ouch. So keep track of your liability status.
Definitely. The whole point of at-risk is ensuring your tax deductions truly mirror your economic risk. No deducting losses you're not genuinely exposed to.
Okay, hurdle 1 cleared. You've shown you have actual skin in the game, but then the tax system asks, okay, but what kind of activity was this? Which brings us to the passive activity loss rules, PLs. This sounds like where things get really interesting with those 3 buckets of income.
Yes, this is where it gets significantly more complex for many investors. The PL rules are a big deal. The absolute core idea is this. You have to divide all your income and losses into 3 categories.
3 buckets, what are they?
Active, portfolio, and passive.
Active, portfolio, passive. Okay.
And the fundamental rule, the one you absolutely have to remember, is that losses from passive activities, well, they can generally only be used to offset income from other passive activity.
Only passive losses against passive income.
That's the general rule. You cannot use those passive losses to reduce your active income like your salary or profits from a business you run day to day.
Okay.
And you cannot use them to offset your portfolio income, like interest, dividends, stock market gains. Think of them as walled gardens. Passive losses stay mostly within the passive garden.
Okay, let's define those gardens, those buckets, what goes where.
Sure. Active income. This is probably what most people think of as earned income. Wages, salary, commissions, bonuses. Also, profit from a trade or business where you materially participate. We'll need to define that term later. It's critical.
Materially participate. Got it. What else for active?
Gain on selling assets used in your active business, too.
Okay. Bucket 2, portfolio.
Portfolio income. This is your classic investment income. Interest, dividends, annuities, royalties, unless those royalties are part of your active business, which is rare. And of course, capital gains and losses from selling investment property like stocks and bonds.
Your typical brokerage account stuff.
Pretty much. And bucket 3, passive. Passive activity income or loss. This comes from 2 main sources. First, any trade or business where you do not materially participate. You're an owner, maybe, but not heavily involved in the operation.
A silent partner type thing?
Could be, yeah.
Right.
And second, this is a big one with only a few exceptions. All rental activities are automatically considered passive, even if you spend a lot of time on them.
All rental activities. Wow. Okay. That seems important.
It's huge. So why do these categories matter so much? Let's use some examples.
Please.
Eleanor. She's a doctor, earns $400,000 a year from her practice. That's active income, right?
Right. She materially participates.
Definitely. Now she invests in, say, a limited partnership that owns a shopping center. She doesn't manage it. It loses $150,000 one year, her share. That's a passive loss.
And the rule says?
The rule says she cannot use that $150,000 passive loss to offset her $400,000 active doctor income. That loss is stuck for now.
Okay. Example 2.
And she lives off investments, makes $500,000 a year in dividends and interest. Portfolio income.
Pure portfolio.
Right. She also invests in a passive activity, maybe a different partnership, that loses $100,000. Can she use that loss against her portfolio income?
Based on the rule?
No,
Yeah.
correct. She cannot. Passive loss can't offset portfolio income.
So these losses just pile up. That seems harsh.
They do pile up, but here's the strategic angle.
What?
Let's take Jan. She has good active income, maybe $200, and she has a $90,000 passive loss from a previous investment, just sitting there, suspended. She can't use it.
Right.
Her CPA says, hey, Jan, what if you invested in another passive activity, one that's expected to generate income? So Jane finds one, maybe invests in a profitable rental property managed by someone else. It generates $100,000 of passive income for her.
Ah, now she has passive income.
Exactly. Now she has $100,000 passive income. She can use that previously unusable $90,000 suspended passive loss to offset $90,000 of that new passive income.
So she only pays tax on $10,000 of that new income.
Precisely. She unlocked the trapped loss by generating passive income. That's a fundamental PL planning strategy. Understanding the buckets lets you see these opportunities.
That's a great point. So what happens to those suspended losses if you don't generate passive income? Do they eventually expire?
No, they don't expire. They carry over indefinitely, waiting for future passive income.
Okay.
But there's another crucial way to unlock them. If you sell or dispose of your entire interest in that specific passive activity.
The whole thing, not just part of it.
The whole thing. And it has to be in a fully taxable transaction. Selling it to an unrelated party is the usual way, if you do that. Any suspended losses remaining from that specific activity are freed up.
Freed up how?
They can then be deducted against any kind of income in that year. Active income, portfolio income, whatever.
Wow, okay. That's a big release valve then.
It really is. Let's use Matt. He has $300,000 active income. And he's got $150,000 in suspended PLs from a single passive investment he's held for years.
Can't use it against the active income, we know that.
Right. But then he sells that entire passive activity. Let's say he sells it for a $100,000 profit. That profit itself is passive income.
So he can use some of the suspended losses against that profit.
Yes. He uses $100,000 as $150,000 suspended loss to completely wipe out the tax on that $100,000 gain.
Okay, makes sense. What about the leftover $50,000 suspended loss?
Now, because he disposed of the entire activity, that remaining $50,000 suspended loss is fully released. He can now deduct it against his $300,000 of active income.
That's huge. So selling the activity unlocked everything.
Exactly. The disposition rule is critical. It ensures that eventually your real economic losses are recognized, even if they were trapped as passive losses for years.
This sounds like it could catch a lot of people. Who exactly gets hit by these PL rules? Is it just individuals? And how do you even figure out what counts as one activity if you have, like, multiple businesses or rental properties?
Good questions. The PL rules apply primarily to individuals, estates, and trusts. But they also apply to certain corporations specifically, personal service corporations, PSCs, and closely held C corporations.
Why those corporations?
Well, PSCs think doctors, lawyers, accountants operating as corporations were targeted to prevent high-income professionals from easily sheltering their service income with passive losses bought on the side.
Okay.
And closely held C Corp, basically. Regular corporations where 5 or fewer people own more than 50% of the stock, they have a special twist. Unlike individuals or PSCs, they can use passive losses to offset their active business income.
Oh, really? That's different.
It is. But they still cannot use passive losses to offset their portfolio income, interest, dividends, etc.
Can you give an example of that difference?
Sure. Imagine Pat, an individual. He has a $100K passive loss, $75K active income, $25K portfolio income. He can't offset any of that passive loss currently, right? It's suspended.
Right, based on what we said.
Now compare that to Brown Corp, a closely held C corporation with the exact same numbers. $100 passive loss, $75K active business income, $25K portfolio income. Brown Corp can use $75,000 of its passive loss to offset its $75,000 of active income.
Wow, so its taxable active income becomes zero.
Correct. It still has the $25,000 passive loss remaining, which is suspended. It can't offset the portfolio income, but that's a huge difference compared to Pat. The entity type matters.
Definitely. Now, about defining an activity. If someone has, say, 3 rental houses and a small shop, are those 4 activities? Or 1? How does that work?
That's often a judgment call, and it's really important. The rules say taxpayers must group their operations into appropriate economic units based on all the facts and circumstances.
Facts and circumstances. Sounds vague.
It can be. You look at things like similarities between the operations, common control, common ownership, geographical location, and interdependencies between them. The goal is to group things that truly function as an integrated economic unit.
Why is the grouping so critical?
2 main reasons. First, if you group multiple operations into one activity, you only need to determine material participation for the activity as a whole. Second, and maybe more importantly, remember the disposition rule. You only get to deduct all suspended losses when you dispose of the entire activity.
Ah, so if you grouped 3 rentals together as one activity, selling just one of them wouldn't trigger the full release of suspended losses.
Exactly. You'd have to sell all 3. If you treated each as a separate activity from the start, selling one would release the suspended losses allocated just to that one.
So your grouping choice up front has big downstream effects.
Huge effects. And be aware the IRS can step in and regroup your activities if they think your grouping doesn't reflect economic reality, or if it looks like your main reason for grouping was just to get around the pay-all rules.
Okay. Any special grouping rules for rentals?
Yes. Generally, you can't group a rental activity with a non-rental trade or business unless one is really insignificant compared to the other. And usually, renting out real estate is treated as separate from renting out, say, equipment, personal property.
Think about someone like Charles, the entrepreneur you mentioned. Software stores, bakeries, rental shops. He's got a complex grouping decision to make.
Absolutely. How he groups maybe all the bakeries together or each location separately, or maybe grouping rentals by city will directly impact when and how he can deduct any losses from those ventures. It requires careful thought and often professional advice.
Okay, this term material participation keeps coming up as the dividing line between active and passive for non-rental businesses. What does it actually take to meet that standard? It sounds involved.
It is involved. It's the absolute key for determining whether your loss from a trade or business that isn't a rental is active or passive. If you materially participate, any loss is active deductible against anything. If you don't, it's passive limited to passive income.
So what's the definition? Is it just putting in hours?
It requires participation that is regular, continuous, and substantial. That's the legal standard.
Regular, continuous, substantial. Still sounds a bit fuzzy.
It is. So the IRS provides specific tests in the regulations, 7 of them, actually, to give more concrete ways to meet that standard. Some are based on hours, like spending more than 500 hours a year.
500 hours. Okay, that's significant. Like 10 hours a week.
Right. Another test is if your participation was substantially all the participation in the activity by anyone, or spending more than 100 hours if that's more than any other individual involved. There are others too, looking at facts and circumstances or prior participation.
What kind of work counts as participation?
Generally, any work you do in connection with the activity where you own an interest counts.
Yeah.
Management activities count, operational work counts. But importantly, work that isn't typically done by an owner, especially if a main reason for doing it is just to avoid the PL rules, might not count.
Interesting. And you mentioned the spouse's work counts.
Yes, that's a big one. Your spouse's participation hours and efforts are treated as your participation, regardless of whether they have an ownership interest or whether you file jointly.
So teamwork makes the dream work for material participation.
You could say that. It's a key planning point for couples involved in a business. Now, one group usually doesn't materially participate, limited partners.
Why not?
Because the nature of a limited partnership is, well, limited involvement in management. So generally, income or loss allocated to a limited partner is considered passive, though there are a few narrow exceptions where they can meet the material participation tests.
Let's connect this to those examples. Rita, the retired accountant working in a hardware store.
Right. Whether her loss from the hardware store is active or passive hinges entirely on whether her work there meets one of those material participation tests. Is it regular, continuous, substantial? Does she hit the hour thresholds?
And her old accounting firm income.
That's likely active income, even though she's retired. Why? Because there's a special rule. If you materially participated in a personal service activity, like accounting, for any 3 prior years, your subsequent income from it remains active. Her long career means she easily met that.
Okay. And Alan, whose accountant told him he didn't materially participate, so now he wants his wife to help out.
That highlights the planning. If his wife genuinely starts working in the business in a regular, continuous, substantial way, her hours count towards his material participation. It could potentially flip the activity from passive to active for them.
Strategic use of spousal participation. Now, you said rentals are different.
Yes, critically different. Remember the general rule. All rental activities are treated as passive by default. Doesn't matter if you spend 1,000 hours managing your properties. The law starts by labeling it passive.
Unless there are exceptions.
Unless there are exceptions, which leads us nicely into real estate.
Ah, yes. Given how many people invest in rental properties, surely there must be some way around that automatic passive label sometimes. And also, what about borrowing money specifically to invest, like buying stocks on margin? Any limits there?
Yes, on both counts. For real estate rentals, despite the general always passive rule, there are 2 very important exceptions that can let you deduct losses against other income.
Okay, what are they?
The first is for real estate professionals. This is a tough one to meet. You qualify if, basically, real estate is your main job.
Tell me.
You have to spend more than half of all the personal services you perform during the year in real property trades or businesses. And you have to spend more than 750 hours in those real estate activities. And you have to materially participate in them.
Wow. More than half your work time and over 750 hours. That's definitely for full-timers.
Exactly. If you meet all that, then your rental real estate losses are not automatically passive. They can be treated as active losses deductible against anything.
Okay, that helps the pros.
Yeah.
What about the average person with a rental property or two?
That's the second exception. Active participation in real estate rental activities. This is much more accessible. If you actively participate in a rental real estate activity, you might be able to deduct up to $25,000 of losses from that activity against your non-passive income, your salary, portfolio income, etc. each year.
Up to $25,000. That's useful. What does actively participate mean? Is it the same as materially participate?
No, it's a lower standard. You don't need regular, continuous, substantial involvement. It generally means making management decisions in a significant and bona fide sense. Things like approving tenants, deciding on rental terms, approving capital expenditures or repairs. You can even hire agents or managers and still be an active participant.
Okay, easier bar to clear. Any other catches?
Yes, two big ones. First, you and your spouse must own at least 10% of the value of the rental activity. Second, that $25,000 deduction allowance gets phased out based on your income.
Ah, an income limit. What is it?
The $25,000 allowance starts to decrease once your modified adjusted gross income, or MGI, goes over $100,000. It's reduced by 50 cents for every dollar your MGI exceeds $100.
So it disappears completely at
$150,000 of MGI. If your income is above that, you don't get this $25,000 exception, even if you actively participate.
Okay, that's a crucial limitation. Let's think about Odette and her beach house rental.
Right. Her situation highlights another nuance. If the average period a customer uses the property is 7 days or less, think typical weekly beach rentals, it's generally not considered a rental activity for these specific PL rules.
So she wouldn't qualify for the $25,000 active participation allowance.
Correct, because it's not technically a rental activity under that definition.
Yeah.
However, this could be good news or bad news. If it's not a rental activity, it's just a trade or business. Its status then depends on her material participation. If she does materially participate, maybe manages bookings, cleaning, etc., over 100 hours and more than anyone else, losses could be active. If she doesn't, they're passive, and she doesn't get the $25K allowance.
So her planning idea.
Her idea to get longer-term tenants, pushing the average stay over 7 days, would make it qualify as a rental activity. Then, assuming her income isn't too high, she could potentially use the $25,000 active participation allowance, even if her involvement isn't enough for material participation. It's about understanding how these definitions interact.
Fascinating. How average rental duration can flip the tax treatment. Now, shifting gears, slightly borrowing to invest, margin loans, etc. You mentioned limits there too.
Yes, the investment interest limitation. This is separate from PLs, but also limits deductions. The backstory is similar, preventing a perceived mismatch. People used to borrow money, deduct the interest expense against their ordinary income, tax at high rates, but the investments they bought generated long-term capital gains, taxed at lower rates.
So deducting high tax rate expenses against low tax rate income.
Exactly. So the rule now is your deduction for investment interest expense in any given year cannot exceed your net investment income for that year.
Net investment income, what does that include?
Generally, it's your gross income from property held for investment, think interest, non-qualified dividends, annuities, royalties, minus certain investment expenses. Importantly, qualified dividends and net capital gains are generally not included by default.
Why not?
Because they get preferential lower tax rates. So you can't deduct interest against income that's already getting a tax break, typically.
But is there a way to include them? Maybe if you need more investment income to deduct your interest.
Yes, there's an election. You can choose to include some or all of your net capital gains and qualified dividends in your investment income calculation. You do this on Form 4952.
What's the catch?
The catch is any amount you elect to include this way loses its preferential tax rate. It gets taxed at your ordinary income rate instead.
Ah, so you get a bigger interest deduction now, but you pay more tax on that specific chunk of capital gains or dividends later.
Precisely. It's a trade-off you have to calculate. Is the immediate value of the interest deduction worth giving up the lower rate on the gain or dividend? Sometimes yes, sometimes no.
And if your interest expense is more than your net investment income, even after the election.
Any disallowed investment interest isn't lost. Just like suspended PLs, it's carried forward indefinitely to future years, where it can be deducted if you have enough net investment income then.
Wow, okay. We've really covered a lot of ground. The at-risk foundation, the PL buckets, these real estate exceptions, investment interest. So pulling it all together, what are the key takeaways for planning? How can investors proactively navigate these complex rules?
It really comes down to understanding how these pieces interact. For the PL limits, a key strategy, maybe counterintuitive, is sometimes to acquire more passive activities, but ones that generate income. Passive income generators, or PIGs as they're sometimes called.
Eggs, okay.
Yeah, it sounds funny, but finding investments that throw off passive income can be the key to unlocking those suspended passive losses, PLs from other ventures.
Use the pigs to absorb the PLs.
Basically, yes. Also, think about how you finance passive activities. Maybe use cash instead of borrowing, or consider if borrowing against home equity makes sense, as that interest might be deductible differently.
And timing the sale.
Absolutely. Timing the disposition of a passive activity is crucial. Selling it unlocks suspended losses. So if you have large suspended losses, realizing a gain on sale might be very tax efficient because the gain gets immediately offset.
What about changing your participation level?
That's a sophisticated one. If you have a business that's consistently profitable and generating active income, but you also have a bunch of suspended PLs from other things,
Yeah.
you might intentionally reduce your involvement in the profitable business so you no longer materially participate.
Turn active income into passive income.
Exactly. If you become, say, more of a silent partner, that income might become passive. Now it can be sheltered by your existing PLs. It's about consciously managing your participation level to optimize the tax outcome.
That requires really knowing the rules and for investment interest.
Remember that election on Form 4952? If you have disallowed investment interest, consider electing to treat some capital gains or qualified dividends as investment income. Run the numbers, see if giving up the lower rate is worth the bigger interest deduction now.
Okay, one last thing. Is there anything else layered on top of all this?
Yes, for higher income folks, there's the net investment income tax, or NIT.
NIIT. What's that?
It's an additional 3.8% tax levied on the lesser of your net investment income or the amount your modified AGI exceeds certain thresholds.
Thresholds like.
For 2024, it's $250,000 for joint filers, $125,000 for married filing separately, and $200,000 for single or head of household.
And what counts as net investment income for this tax?
It includes the usual suspects: interest, dividends, capital gains, annuities, royalties, rents, and importantly, income from businesses considered passive activities.
So passive income can get hit twice regular tax, plus potentially this 3.8% IIT.
That's right. This NIIT can significantly boost your effective tax rate on investments. It can push the top rate on long-term capital gains and qualified dividends from 20% up to 23.8%. And for interest or passive income tax at ordinary rates, it could push the top federal rate from 37% up to 40.8%.
Oof. So understanding PALs isn't just about loss deduction. It also impacts whether income gets hit by this extra tax.
Precisely. It makes understanding all these interacting rules at risk, PLs, investment interest, NIT, even more critical for effective tax and financial planning.
That was definitely a deep dive. We went from why these rules exist through at-risk, the 3 PL buckets, special real estate rules, interest limits, planning strategies. You should now have a much clearer picture of how investor losses and income are treated by the tax code. Hopefully, you feel more confident navigating this.
Absolutely. The rules are complex, no doubt. But getting your head around the core ideas: how much are you truly risking? How is your income categorized? Active, passive portfolio? Are you materially participating or just actively? That understanding is just essential for smart financial decisions. It really shapes your overall tax picture.
So here's something to think about as we wrap up. We've talked a lot about rules limiting losses, but these rules also define what it means to be truly involved in your investments, don't they? How might consciously changing your level of involvement, becoming more active or maybe strategically less active, change the entire tax outcome for one of your investments? Something to chew on.